Hey, what's up everybody? So we're going to be talking about Facebook stock or meta platforms. Now we'll be doing a stock analysis in this video, a valuation of the company based on current metrics, and a DCF model at the end of the video. Now this video is going to be all about valuation. Remember, a lot of people like to jump into the story. They like to buy into the story and not really buy into the numbers. And when you're investing your hard-earned money, you should be looking at the numbers and not getting all uppity and happy about a story and then just investing based on a story. And I'm not going to delay. Let's just jump right into Facebook stock meta platforms. Now, the first thing I really like to look at to get a basic idea of how a company is looking is the PE ratio. Now, I like to see a PE ratio under 20. And Facebook comes out to, and I'm sorry, I just can't, I'm still going to call it Facebook. I'm just not used to the whole meta thing and calling it meta platforms, whatever it is. But the PE ratio comes out to 22. Now, remember, PE ratio isn't the only indicator of where a company's at. And just because a company is a little higher than that 20 that I like to see it at doesn't necessarily mean anything. Remember, it's a basic guideline number, and higher PE ratios can be justified if a company is growing really well. You will see from some numbers that we run that Facebook does have pretty good growth, so that PE ratio is probably pretty darn justified, especially only being a little over the 20 that I like to see. Now here's a really big thing that we want to look at. It is the growth of the company, and this is broken into 3 different sections: the revenue growth, the net income growth, and the free cash flow growth. Now we'll be using the numbers 2016 to 2020 because we still haven't gotten the fourth quarter for 2021 for Facebook. So I can't really go by 2021 numbers for most of this stuff. Now I will be reading off a sheet. Yes, I'm a little old-fashioned. I suck at using Excel and I hate working out numbers on a computer. So this is what I do. I write out all my stuff. I write out everything on a sheet, every calculation, everything I do. So we'll be reading some numbers off of this sheet where I laid everything out so that I know what the heck is going on. So in 2016, they had revenue of $27.6 billion. And in 2020, they had revenue of $85.9 billion. That is incredible. That is basically 3x growth of revenue. That's just really good. There's no other way to put it. That is extraordinarily strong revenue growth, especially for how big Facebook already is. Next, we'll look at the net income growth. In 2016, it was $10.2 billion, and in 2020, it grew to $29.1 billion. Again, that is a check that grew almost 3 times. And again, just in general, when you're looking at a company and looking at, growth factors like this, you just want to see that the company's growing. So the fact that you're seeing 3x growth factors over this 5-year period is really quite incredible and speaks to what Facebook's been able to do just in this last 5 years. Now, last but certainly not least is free cash flow growth. Now, free cash flow is one of the most important figures inside of a company. When it comes to companies reporting, not them saying Facebook is fudging any numbers, but when it comes to numbers being reported, it is the hardest on income statements to fudge the free cash flow numbers. So these really are important numbers to go by and will actually be applied in our DCF model that we'll do at the end of the video. Now in 2016, they had $11.6 billion in free cash flow, and that grew to $23.6 billion in 2020. Now that's more than 2x growth in free cash flow. Now just in general, you want to see these numbers growing in the positive direction. So the fact that it's more than 2x in 5 years is really, really good free cash flow growth. The third thing I like to look at when evaluating a company is their debt. Under debt, I have two different things that I like to look at to make sure that a company doesn't have too much debt or they can handle and pay off the debt in a reasonable time. I like making sure that a company can pay off their debt within a reasonable time with their free cash flow. Now, I like to take the most recent free cash flow number they had, which in this case would be about $23.6 billion for the year 2020. And I like to multiply that by 3. A lot of people like to use 5-year average, but I like to do 3 years multiplied by the most recent cash flow, free cash flow. I figure if they can pay off their long-term liabilities, their debt, in 3 years or less, they're pretty healthy as a company. Now, multiplying that figure gets us to about $70.8 billion. So now the question comes into mind, is the long-term liabilities more or less than that figure? Well, in Facebook's case, the long-term liabilities are $18.4 billion. That's just ridiculous. Basically what that means, just forget the 3 years, okay? That's what I like to use to see that they can pay off their long-term liabilities within 3 years. Facebook, based on their last free cash flow number in 2020, can pay off all of their long-term liabilities. That's crazy, and pretty much most companies are not able to do that whatsoever. The other thing I like to look at when it comes to debt is the current ratio. Now, current ratio is going to be your current assets divided by your current liabilities. Suffice to say, that basically means that if the company had to liquidate today, could all of their current assets cover all of their liabilities? Now, if we're doing the math on that, that basically means that technically any company over the number 1, after you do the math, would be able to liquidate and cover all of their current liabilities based on those current assets, right? Let's just make up a willy-nilly number just to explain that a little better. If you had $10 billion in current assets and you had $5 billion in current liabilities, if you liquidated, 10 billion divided by 5 billion equals 2 billion, or it comes out to a ratio where it comes out to 2. So anything over 1, they can cover it, but typically they say you want to see at least 2 when it comes to the current ratio, just to feel like the company is relatively healthy. Now, in Facebook's case, I'm sure you could probably take a wild guess the current ratio is really good, especially when we already found out that they're able to pay off all their total long-term liabilities in just 1 year of free cash flow. The current ratio is about 4.23. So again, really, really great number. They have no problems. There's no threat when it comes to their debt. That kind of rhymed. Now, finally, the last thing I like to look at when it comes to a company in doing evaluation is, well, the most important thing, the DCF model, the discount cash flow model that we're going to be doing. Now, I am not going to go through every single number because, as you can quickly see from this paper, there is a lot of calculations that had to be made. There are a lot of calculations when it comes, just a lot of numbers when it comes to a DCF model. But I will mention, the basic relevant ones so that you know what I'm talking about, and basically so you know the low estimates that I made. Also, I'll put a screenshot at the end of the video, if anyone's curious at looking at my numbers for the DCF model I did. For anyone who understands the model. If you don't understand how a DCF model works, it's not going to exactly be very relevant to you. Maybe I'll do a video in the future explaining how it works, but I will put it at the end of the video for just anyone who wants to take a look at it if they do understand DCF models. Now, to get into it, the basic assumptions we need to make for a DCF model is a certain revenue growth over a 5-year projected period. you need a perpetual growth, which helps determine the terminal value. And last but not least, you also need a discount rate. So let's start with the revenue growth that I'm going to project over 5 years. Well, first of all, I took the numbers from the last 5 years and I looked at the average growth rates from those numbers. Now, the average growth rates came out to be about 30%, which is a pretty high number. Now, obviously, we're not going to be using 30%. That's just ridiculous. And it's not using low estimates at all, but it's kind of to get a little bit of a feeling of where we were at. So we're going to look at revenue estimates from a couple different sources. I pulled it from Charles Schwab, because they have a lot of great free information on there if you're a user. That's who I use as my brokerage. And I also pulled from Yahoo Finance as well. So Charles Schwab unfortunately didn't give a 5-year projection, which kind of sucked, but they gave a projection for 2022 with a high of 26%, a mean or middle ground number of 20%, and a low of 16%. Yahoo Finance over the next 5 years, because they do give 5-year projections, gave 21.35% is their average. Now that kind of gives me enough numbers to make my own estimate. And remember, we don't ever want to go really for the middle, and certainly not the high. I'm going for more of the low and then even making my own low. Again, just to remind you, the past 5 years revenue growth was an average of 30%, and the revenue estimates at a low was 16% from Schwab, and Yahoo Finance as an average over the next 5 years was about 21%. I'm going to use 15%. For anyone who doesn't quite understand why we would want low numbers, I'll kind of explain it at the end when all these numbers come together. Now next, our perpetual growth rate that we're going to use for our terminal value is 2.5%. So basically to say after my projected 5 years, for the rest of the company's life, we need a terminal value, a perpetual growth rate, average. I'm using 2.5%. Obviously, that's low. Look, we all know that after 5 years of projected growth, Facebook's going to continue to have pretty good growth numbers, probably above 10% for a good amount of time, at least another 5 years. The reason I use 2.5% as the growth rate for perpetual rate is because that's the average growth of the U.S. economy every year on average, as well as a lot of other economies. And again, it's a low estimate. You want your estimates to be low. And the last number I'm going to mention for this is I'm not going to mention every number. This video would literally be probably like 30 minutes plus long. The other number we want to talk about is my discount rate. Remember, if you're getting anywhere from 8 to 10% in something like an ETF or index fund, then I don't want to go at that rate or lower. I want to do better than an index fund, or why am I investing at all? Why, there's more risk for me to invest in individual stocks than go to an index fund. So I want 12%. So that is my discount rate that I apply to all of my models is 12%. A lot of people would think that's too high. I've seen other people apply like anywhere as low as 5 to 6%. And I'm like, then go invest in an index fund because you're not making any money, or you're making money, but not as much as you could have been without doing any of the work. I'm taking on more risk. I'm doing work. I want 12%. Now, after running my DCF model, the intrinsic value that I got came out to $374.75. Let's just call it a flat $375. And this, people, is why we make the very low assumptions. So I'm assuming that over the next 5 years, the average growth rate is 15%, which is lower than all the analysts estimate. I estimate a perpetual growth rate of 2.5%, which again is probably a pretty low estimate. I also ask for 12% discount rate because I want that much back per year at least. And based on all these low estimates, the fair value still comes out to about $375 today. So based on the DCF model that I ran, Facebook is currently at about an 18% discount. Not only that, but all of my estimates were pretty low, so my upside potential is much higher. This is just basically based on my DCF model. This is the low of the low that it's worth today, $375. So the DCF model says it's definitely a buy. And again, with those low estimates, there is a lot of upside potential there. Now, right now, I'm going to go ahead and put a screenshot of my DCF model that I did written out on that entire piece of paper for anyone who does want to look at it. I only put it up for like maybe a few seconds, and if you're interested in peeking at it, you could just pause the screen. Now with that, this wraps up the video. That is my valuation on Facebook. A great balance sheet according to the DCF model. It's currently worth $375 based on my low estimates that I used. I think there's a good amount of upside potential here. Facebook is a buy based on the model. Thank you to everyone that watched the video. If you feel that this video added value to your day and you like the way I evaluated the company, please give the video a thumbs up to let me know. And let me know how you feel about Facebook in the comments. What do you think? Good investment? Don't forget to subscribe. You all have a great day.